Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden in plain sight within company filings. This time, we're diving deep into Warner Bros. Discovery's latest report, and let's just say their financial story is complex, with big plays being made and some serious numbers to dissect. Think of it like a blockbuster movie plot filled with twists, turns, and a whole lot of cash. Before we dive into the nitty-gritty, if you want more of these no-nonsense breakdowns of important financial documents, make sure you hit that subscribe button. And hey, we've got a fantastic community discussing these insights over on Discord, with the link in the description below. Come join the conversation. Warner Bros. Discovery, or WBD as the cool kids on Wall Street call them, dropped their quarterly report for the period ending the 30th of September 2025. Now, these reports, like this 10Q form, are basically a company's diary for the last 3 months, full of numbers and explanations that tell us how they're really doing. And let me tell you, WBD has been busy. First off, who is WBD again? They're a giant in media and entertainment with brands like HBO Max, CNN, and Warner Bros. Films, they create and distribute content across television, movies, streaming, and even games. Think of them as the ultimate content factory. As of the 23rd of October 2025, their series A Common Stock had a total outstanding share count of over 2.4 billion. That's a lot of ownership pieces out there making WBD tick. Now, let us get to the heart of the matter, the numbers. When we look at their consolidated statements of operations, it is like looking at the scorecard for the last quarter. For the 3 months ending the 30th of September, their total revenues were just over $9 billion. That sounds huge, right? But it's actually down about 6% compared to the same time last year. It's like losing a few million viewers or subscribers. Specifically, their advertising revenue took a hit, dropping 16% for the quarter. That tells us advertisers are spending less with them. Maybe because fewer people are watching their traditional television channels. Imagine if your favorite show suddenly had way more commercials and you were one of the few people still watching. That's tough for the entire 9 months. Advertising revenue was down 10%. Content revenue also saw a dip, down 3% for the quarter and 5% for the 9 months. This isn't necessarily bad. Sometimes it means they are holding onto their best content to use for their own streaming service instead of selling it off to others. It's a strategic trade-off. Now, what about profits? Their operating income for the quarter was $611 million. Sounds good, but last year they had an operating loss of over $10 billion for the 9-month period. That was a massive write-down, mostly from things like selling off parts of their business or devaluing assets. This year they've moved from a huge loss during that same 9-month period to actually making a profit of nearly $400 million. That is a dramatic turnaround in their core business operations. But here is where things get interesting. Even with that operating profit, they had an interest expense of $570 million for the quarter. That's a lot of money just to pay for the privilege of borrowing money. This is a constant pressure, reminding us of the massive debt they carry. When you add it all up, income before taxes for the quarter was a slim $27 million, and for the 9 months it was a much healthier $2 billion, largely thanks to a massive gain on debt extinguishment. What does that mean? They managed to pay off a huge chunk of their debt for less than face value, saving them a lot of money on paper. That's a smart financial move. So after all the costs and taxes for the quarter, they ended up with a net loss of $148 million. But for the 9-month period, they turned it around, reporting a net income of $979 million. This shows a big improvement, with the debt extinguishment playing a key role. Let's peek at their consolidated balance sheets. This is like a snapshot of what they own and what they owe at a specific moment. As of the 30th of September 2025, they had total assets of about $100 billion. That includes things like their film and television content rights, their studios, and a huge amount of goodwill, which represents the value of their brands and reputation above and beyond their physical assets. That goodwill alone is over $25 billion. That's a testament to the value of brands like HBO, but it also means they are heavily reliant on those brands continuing to be valuable. Then there are intangible assets like licenses and intellectual property, totaling almost $29 billion. These are the hidden treasures of a media company. What they owe, their total liabilities are around $63 billion. So, they have more assets than liabilities, which is generally a good sign. Here is a big number. Their non-current debt is over $33 billion. That's the long-term debt they need to pay off. That's a significant chunk of their financial structure. And their total equity, which is what's left after you subtract liabilities from assets, is about $37 billion. This is the value that technically belongs to the shareholders. Now, let's talk about cash. The consolidated statements of cash flows show us where money came from and where it went. For the 9 months ending the 30th of September 2025, they generated $2.5 billion from their operations. That's good. It means their core business is bringing in cash. However, they used about $761 million in investing activities, which often means buying new equipment or investing in other companies. And then Therese financing. They used about $3.1 billion in financing activities. This is largely due to repaying debt and other financial maneuvers. So even though they made money from operations, more cash went out than came in overall, leading to a decrease in their total cash. Okay, let's circle back to that debt mentioned earlier. In their debt section, we see they took on a massive $16 billion bridge loan with an interest rate starting at over 7%. This was to help pay for that big debt buyback we saw earlier. It's a really aggressive move to restructure their debt, essentially taking on new expensive debt to pay off older. Perhaps even more expensive debt. They're trying to manage their finances, but it means they're paying a lot in interest. Their total debt is a staggering $33.8 billion as of September 2025. That is a heavy burden. Now, for something a little more technical, but important, in their derivatives and hedging section, they talk about how they use financial tools to manage risks, like currency exchange rates or interest rate changes. This is common for big companies operating globally. They use things like foreign currency forward contracts and interest rate swaps to try and protect themselves from unexpected financial swings. For example, they're hedging against the risk that the euro or pound might drop in value, affecting their international earnings. Under fair value measurements, they discuss how they value certain assets and liabilities. They explain levels 1, 2, and 3. Level 1 is straightforward based on market prices. Level 2 uses observable data, but not direct market prices. Level 3 is the trickiest, relying on estimates and assumptions when market data isn't available. Most of WBD's assets and liabilities are valued at Level 2, meaning they have some market basis, but the company also holds things valued at Level 3, indicating more estimation is involved. Looking at accumulated other comprehensive loss, we see a significant negative balance of over $431 million. This represents unrealized losses primarily from currency translation and derivative fluctuations. It's like a hidden pool of losses that impacts the company's overall financial picture, even if it is not directly reflected in their income statement for the period. Now, let's break down how WBD sees its own business: streaming, studios, and global linear networks. Streaming is their direct-to-consumer business, like HBO Max. Studios is where they make movies and television shows, and global linear networks is their traditional television channels. Their streaming revenue was flat for the quarter, but up 5% for the 9 months. This is driven by more subscribers, up 16% to over 128 million globally. That's good news, showing growth in their future facing business. However, their global ARPU, which stands for average revenue per user, is down. For the quarter, it fell 16%. This means that while they have more subscribers, each one is spending less on average. This is partly due to more customers in lower priced international markets and a legal issue that might require them to adjust past billing, and partly due to changes in their domestic wholesale deals affecting how much revenue they get per subscriber. The studio segment, where they make movies and television, is showing strong growth. Revenues are up 24% for the quarter and 19% for the 9 months. Content revenue is up a big 26% for the quarter, thanks to hit movies like Superman and Weapons and strong performance from F1. This division seems to be firing on all cylinders, likely benefiting from a strong slate of releases. Global linear networks, their old school television business, is struggling. Revenues are down 22% for the quarter and 13% for the 9 months. Distribution revenue is down because fewer people are subscribing to cable, and advertising revenue is down because fewer people are watching those channels. This segment is clearly in decline, and it shows in the numbers. Their adjusted EBITDA, which is a measure of operating profit before certain expenses, is down 20% for the quarter and 9 months. This is the price of doing business in a shrinking market. Corporate costs, essentially the overhead of running the whole company, are down 13% for both periods. They seem to be tightening their belts at the top. Now, let us talk about their ability to pay their bills and fund their operations, their liquidity and capital resources. As of September 2025, they had $4.3 billion in cash. That sounds like a lot, but they also have massive short-term and long-term debt obligations. The big one is that $16 billion bridge loan, which they plan to refinance. They also have their revolving credit facility and commercial paper programs, which provide additional borrowing power. Here is a stark look at their capital resources, total capacity of over $42 billion, but almost all of that is already earmarked for outstanding debt. They have very little room to maneuver with unused capacity, about $8.3 billion. It's like having a huge credit card limit, but most of it is already spent and they need to be careful with every dollar. Finally, the cautionary note, this is where companies warn us about the future. WBD is facing big unknowns. They are planning to split into two companies, Warner Bros. And Discovery Global. But they are also exploring other strategic options like selling the whole company or parts of it. This uncertainty is a big risk. It could disrupt their business, affect employee morale, and even delay that planned separation. They're basically saying things could change a lot and we're not sure exactly how. This section on their review of strategic alternatives really sticks out. They are actively considering selling off parts or all of the company on top of already planning a major separation. This creates a huge amount of uncertainty. Investors hate uncertainty, and this can lead to a lot of stock price volatility. Think of it as a company in constant flux, trying to find its best path forward while juggling massive debt and a changing media landscape. So, what is my take? WBD is navigating a turbulent industry with a massive debt load and big strategic decisions to make. Their streaming and studio segments are showing signs of life and growth, which is a good sign for the future. However, their traditional linear networks business is clearly in decline, and they are paying a steep price in interest on their debt. The ongoing restructuring, the planned separation, and now the potential sale of the company create a lot of risk, but also the possibility of unlocking significant value if they manage it correctly. They are in a period of significant transformation, and the next few years will be crucial in determining their long-term success. That wraps up our deep dive into Warner Bros. Discovery's latest filing. What do you think about their big moves and financial situation? Are they on the right track, or is there more turbulence ahead? Let me know your thoughts in the comments. If you found this breakdown helpful, please give it a thumbs up and subscribe for more content like this. And don't forget to join the conversation in our Discord community, linked in the description. Thanks for watching, and I'll see you in the next episode.